Why can't you hold on to profits? The psychology of the fear of winning and strategic solutions. In the brutal arena of financial trading, technical analysis is often seen as the cornerstone for beginners. But the key factor that truly determines whether a trader can survive in the market for more than 5 years usually lies in the resilience of their psychological makeup. As a trader with 15 years of combat experience in the markets, I have observed a universal phenomenon. It crosses borders, capital sizes, and experience levels. And that is, traders have an astonishing endurance for losses, but show extreme panic and impatience when it comes to profits. This phenomenon is known in academia as the disposition effect. But in the trading room, we call it, quite bluntly, the fear of winning. In today's episode, we are going to provide you with a deep, theoretical, and practical guide. We won't just stop at describing the surface phenomena. We are going to dive deep into Daniel Kahneman and Amos Tversky's prospect theory. We will dissect how your brain processes the difference between realized utility and paper utility. We will reveal why the evolutionary mechanisms of the human brain make cutting winners short and letting losers run a natural physiological response, rather than just a simple lack of discipline on your part. More importantly, we will provide a set of battle-tested solutions. We will break down the tactical applications of scaling out and trailing stops in detail. We will prove that these strategies are not just tools for risk management, they are extensions of your psychological defense mechanism. They effectively bypass the fear response of the amygdala, helping you reshape your expectancy in a highly uncertain market and achieve the transformation from passive emotional reaction to active strategic execution. To a trading novice, the concept of fearing winning sounds like an absurd paradox. Doesn't everyone enter the market to make money? However, when we dissect the emotional spectrum of trading, we find that this so-called fear is not directed at the money itself. It is directed at the pain of giving back profits and the stress of uncertainty. Traders with 15 years of experience know this truth. Holding a losing position is often psychologically easier than holding a winning position. This sounds counterintuitive, but the logic behind it is this. A losing position brings a kind of numb hope. As long as you don't close the trade, the loss is just a paper number. The brain constantly weaves reasons for a price reversal. This hope shields you from the reality of the pain. Conversely, when holding a winning position, the trader faces fear every single second. Fear that the profit will vanish, fear that the market will reverse, fear that they will ruin a good hand because of greed. This psychological tension does not stem from a weakness of character. It stems from the brain's reward mechanism. When floating profits appear on the screen, the brain's dopamine system has already spent the pleasure brought by this wealth in advance. At this moment, any pullback in price is no longer seen as normal market fluctuation. It is seen as the robbery of real wealth. To protect this pleasure from being stolen and to eliminate this anxiety, the trader instinctively chooses to bag the profit. This is an emotional regulation mechanism. You are sacrificing potential future windfalls in exchange for immediate peace of mind. To fundamentally understand this behavior, we must trace it back to the foundational work of behavioral finance in 1979, prospect theory. Kahneman and Tversky's research completely overturned traditional economics expected utility theory, which assumed that humans are rational and always seek to maximize wealth. Prospect theory points out that when humans face risk decisions, we do not evaluate value based on the final total wealth. Instead, we evaluate based on changes in gains and losses relative to a specific reference point. Here is a core concept: the S-shaped value function. This curve reveals the mathematical roots of distorted trader behavior. First, let's talk about risk aversion and gains. The value function presents a concave shape in the profit zone. This means as the amount of profit increases, the psychological satisfaction, the marginal utility, derived from each additional unit of profit decreases. Making $1,000 makes you happy. But making $2,000 instead of $1,000 does not double your happiness. However, the anxiety caused by uncertainty increases as the holding time extends. Therefore, traders tend to choose a certain smaller profit rather than gambling on an uncertain larger profit. This explains why you rush to close a trade when you've made 20 points, even if your system signals you could make 100. Second is risk-seeking in losses. The value function presents a convex shape in the loss zone. This means the pain brought by a loss is extremely intense at the beginning, but as the loss expands, the sensitivity to pain actually decreases. Losing $1,000 hurts deeply, but going from losing $1,000 to losing $1,100 feels like much less of a difference. More importantly, to avoid realizing that confirmed failure, traders are willing to take huge risks to bet on a price recovery. This is why traders death grip losing positions and even average down during losses just to pursue that tiny probability of breaking even. Let's summarize the inner monologue behind this. In the gains domain, you are risk-averse. You think, quit while you're ahead, bag it. What if it falls back? The result is cutting winners short. In the losses domain, you are risk-seeking. You think, it's not a loss until I sell. It will definitely come back. The result is letting losers run. In academic research, the reference point is usually set as the purchase price. But in the heat of high frequency and day trading, the reference point is highly dynamic and dangerous. Research shows that a trader's reference point drifts rapidly with price fluctuations. For example, you buy a stock at $100. When the price rises to $110, your mental account may already view $110 as wealth you deserve. If the price then pulls back to $108, even though you still have an 8% profit relative to your $100 cost, relative to your new reference point of $110, you feel like you have lost $2. The pain of this virtual loss triggers a strong impulse to take profit because you don't want this loss to expand to $105 or $100. This upward shift of reference point is the main culprit causing traders to fail at holding big trend trades. Traders are not protecting their principal. They are protecting the largest floating profit number that once flashed on the screen. The disposition effect is the concrete manifestation of prospect theory in financial markets. It refers to the tendency of investors to sell winning assets too early, while holding losing assets too long. This is not just a feeling, it is a behavioral pattern that can be precisely quantified by big data. In 1998, Terence O'Dean conducted a groundbreaking study on 10,000 accounts at a large discount brokerage. He proposed a rigorous set of quantitative indicators to measure this effect. One is the proportion of gains realized, PGR. The other is the proportion of losses realized, PLR. O'Dean's data showed something shocking. PGR is significantly higher than PLR. Specifically, on any given trading day, if a stock in an account is profitable, the probability of it being sold is about 60% higher than that of a losing stock. This means retail investors are far more active in harvesting winners than they are in stopping losers. Further empirical research has revealed a more detailed selling behavior pattern, presenting a V-shaped curve. First is the jump at zero. When the price returns near the cost basis, break even, the probability of selling skyrockets. This explains why many trapped stocks encounter huge selling pressure when they bounce back to the cost zone. Traders are eager to erase the mistake. As long as they can get out unscathed, they are willing to give up all potential profits. Second is constant selling pressure in the profit zone. Contrary to prospect theory's prediction that the higher the price, the less you want to sell, actual trading data shows that as the profit margin increases, the tendency to sell does not significantly decrease. It even rises in certain ranges. This indicates that the pressure of fear of profit retracement is directly proportional to the size of the profit. The more you earn, the heavier the psychological burden. Finally, the death grip in the loss zone. In the loss zone, selling probability is extremely insensitive to price changes. Whether losing 5% or 20%, traders tend to play dead. This paralysis towards loss is only broken when the magnitude of the loss reaches a devastating capitulation point. Why does bagging the profit have such magic power? Barbaras and Xiong proposed a key psychological distinction in 2009, realized utility versus paper utility. In traditional economics, $1,000 on paper and $1,000 in your pocket are equal in value. But in neuroeconomics, they are completely different. Realizing a gain triggers an intense positive emotional pulse in the brain, a utility burst. This is not just a confirmation of wealth. It is an affirmation of the ego. I was right. I beat the market. This pleasure is addictive. To frequently get this dopamine hit, traders tend to engage in high-frequency trading, constantly harvesting tiny profits. Realizing a loss, however, triggers a strong negative emotional pulse. It forces the trader to admit, I was wrong. I am stupid. To avoid this blow to self-esteem, traders choose to postpone closing the position indefinitely. Because as long as they don't sell, this mistake remains in a state of Schrödinger's cat, where there is still a possibility of a turnaround. The disposition effect is not just psychological discomfort. It translates directly into financial disaster. Odeon's study tracked the performance of winners sold by investors versus losers they kept holding over the subsequent year. The results showed that the winner stocks that were sold too early outperformed the loser stocks that were held onto by an average of 3.4%. This is the fundamental equation of retail losses. Using a high win rate, frequent small profits to cover up a low expectancy, huge potential losses, and missed windfalls. You might make $100 in each of 9 trades. But in the 10th trade, you hold on to a loser and lose $1,000 or even more. Your win rate is 90%, but your account balance is negative. I often remind people, your brain was designed to survive in the jungle, not to trade on Wall Street. Dopamine is the neurotransmitter that drives us to pursue profit. When you see a perfect chart pattern, dopamine levels rise, driving you to place an order. However, dopamine is very sensitive to prediction error. When profit appears, dopamine spikes. When profit starts to retrace, dopamine levels drop rapidly below the baseline, creating a pain similar to a withdrawal symptom. To stop this pain, the prefrontal cortex, the center of rational decision-making, gets hijacked by the amygdala, the emotion center. It issues a command, close the position immediately. This is a biological pain relief behavior. The disposition effect is also deeply driven by the emotion of regret. Traders face a game of 2 regrets. Regret A, you didn't sell and the profit turned into a loss, a round trip. Regret B, you sold and the price continued to skyrocket. Selling too soon. For most people, the pain of regret A is far greater than regret B, because regret A involves something you already had being taken away, the endowment effect, while regret B is just missing something you didn't have, opportunity cost. Furthermore, research by Sheffrin and Statman points out that traders often attribute profits to their own skill, internal attribution, and losses to market manipulation, external attribution. To lock in that evidence that proves their skill, the winning trade, traders are eager to close the position. Sunk costs are usually used to explain why people won't stop a loss. They've invested principal. But on the profit side, sunk costs manifest as investment of time and energy. If a trade has cost you a lot of time watching the screen, enduring volatility, you feel that this profit is hard-earned. This mindset makes you overprotective of the profit, unwilling to let it bear any risk, leading to premature exit. Holding a position is, in itself, a stressor. As long as the position is open, your brain must constantly monitor risk. Cortisol, the stress hormone, levels continue to rise. This physiological state is unsustainable. The fear of winning is often just the inability to endure continuous stress. The moment you close the position, regardless of profit or loss, the physiological stress is instantly released. Many traders are actually paying the market in exchange for relief from stress. Since we know the brain's biological mechanism tends towards bagging the profit, trying to fight this instinct with willpower alone often fails. The smarter approach is to design a trading system that accommodates this psychological need, while retaining the mathematical expectancy of the profit. This is the core philosophy of scaling out. Scaling out means closing part of the position, like 1/3 or 1/2, at a predetermined profit target, and keeping the remaining position to capture a larger trend. This strategy perfectly resolves the contradictions of prospect theory. First, it satisfies the reptilian brain. By locking in some profit, you get the dopamine reward of realized utility. Your ego is satisfied proving, I was right about this trade. Second, it releases anxiety. Once part of the profit is in your pocket, the psychological cost of the remaining position is drastically reduced. If the remaining position gets stopped out at break-even, the trade as a whole is still profitable or neutral. This state is called a risk-free trade, or a free ride. Critics often say scaling out reduces maximum profit potential, but in combat, this is the difference between theoretical maximum and actual execution value. Let's compare two scenarios. Strategy A is all or nothing. Strategy B is scale out 50% at 1R. Suppose the price hits target 1, then reverses to stop loss. The result of strategy A is a -1R loss. This is a loss caused by greed. The result of strategy B is break-even or a small profit. You locked in 0.5R. Suppose the price hits target 2, which is +3R. Strategy A results in a +3R profit. But the psychological pressure is immense. Extreme anxiety, fear of retracement, easy to get shaken out along the way. Strategy B results in a +2R profit. Although you made a bit less, the psychology was relaxed. You were playing with house money. You were calm and much more likely to hold until the end. For traders plagued by the disposition effect, strategy B wins completely in terms of stability of expectancy and execution, even if the mathematical ceiling is slightly lower. Based on my experience, I suggest choosing one of the following 3 modes based on your style. Mode 1, the 2-to-1 financing model. This is a method favored by many momentum traders. Setup: assume risk is $100, 1R. Execution: when profit reaches $100, 1R, sell 50% or 75% of the position. Logic: this operation directly finances the risk. Even if the remaining position is stopped at entry, you won't lose money. This hugely liberates psychological pressure, allowing you to dare to aim for the 3R, 5R, or even 10R windfalls that might follow. Mode 2, the technical structure ladder. Use market structure as exit points, rather than just dollar amounts. First batch, previous high resistance or whole number levels. Sell 1/3. Second batch, Fibonacci extension levels. Sell 1/3. Third batch, when the trend structure is broken, like falling below the previous swing low. Sell the final third. Logic: this method links your exit to the objective movement of the market, reducing subjective guessing. Mode 3, time-based scaling, suitable for ultra-short-term trading. Rule: if price does not explode as expected within X candles after entry, reduce position by half. Logic: clear out those positions with insufficient momentum, freeing up both psychological capital and financial capital. Scaling out solves the problem of how to start taking profit. Trailing stops solve the problem of when to end the profit. It is the specific cure for selling too early, because it hands over the decision-making power of selling, from your emotional brain to objective mathematical rules. The core value of trailing stops lies in eliminating decision fatigue. Without a trailing stop, you are making a decision every second. Sell now or wait. With a trailing stop, your decision becomes a binary check. Did price trigger the rule? No? Then do nothing. This agency delegation mechanism effectively bypasses the interference of the amygdala. Strategy 1 is the ATR chandelier exit. Average true range, or ATR, is the best tool for measuring market volatility. Using ATR as a trailing stop ensures your stop distance is dynamically adjusted based on current market noise. The formula is uptrend stop price equals current high minus ATR value times multiplier. The multiplier is usually set to 2.5 or 3. The psychological advantage is when market volatility is high, ATR gets larger, the stop widens, preventing you from being shaken out by normal washouts. When the market is calm, ATR gets smaller, the stop tightens, protecting profits. This gives the trader a sense of scientific security rather than setting stops based on feeling. Strategy 2 is market structure trailing. For price action traders, this is the most natural strategy. Rule: In an uptrend, as long as price keeps making higher highs and higher lows, hold. Action. Every time a new swing low is confirmed on the chart, manually move the stop to 1 or 2 ticks below that low. Discipline. Unless a new structure forms, absolutely do not move the stop. Advantage. You exit because the trend is defined as over, not because you got scared. This is the ultimate expression of following trading logic to the end. Strategy 3 is moving average surfing, using moving averages as dynamic support. Short-term momentum. Surf along the 8 EMA or 9 EMA. As long as the candle close does not break the line, hold on for dear life. Swing. Trend. Surf along the 20 simple moving average or 21 exponential moving average. Detail. You must wait for the candle body to close below the average to exit. The wicks piercing through do not count. This requires extreme stability, but can filter out the vast majority of fake breakdowns. After being in the market for a long time, I've found that technical means only solve 50% of the problem. The other 50% lies in the trader's underlying cognition of money. Many traders, especially full-time traders, suffer from the income mentality. They view trading as a paycheck, needing to make $500 a day to pay rent. This survival pressure is the catalyst for the disposition effect. When you desperately need this money to pay bills, you absolutely cannot tolerate profit retracement. You will be like a startled bird, fleeing at the slightest rustle of leaves. Solution. You must completely isolate living expenses from trading capital. If you are trading with next month's rent, you are destined to fail. Trading must be counterintuitive, and the survival instinct is the strongest human intuition. To cure the disposition effect, you must shift from focusing on win rate to focusing on expectancy. Novices ask, will this trade make money? Veterans ask, what is the risk-reward ratio of this trade? Combat training. I recommend establishing a shadow portfolio. In your trading journal, record 2 columns of data. Column 1 is actual operation, the result of you closing early out of fear. Column 2 is system operation, the result if you had strictly followed the trailing stop. After accumulating 20 trades, compare these 2 numbers. When you see with your own eyes that you made $10,000 less because of fear, this pain will become the strongest motivation for you to correct your behavior. Use regret to fight fear. Trading is an eternal war against the primal settings of your own brain. Over 15 years, I have seen countless talented analysts leave the market in sorrow because they could not overcome the disposition effect. I have also seen traders with average technical skills, but extremely strong psychological resilience accumulate massive wealth simply by cutting losses and letting profits run. Not being able to hold on to profits is not because you are greedy. It is precisely because you want to be safe. You are trying to find certainty in a chaotic system full of uncertainty, and bagging the profit is the only certainty you can control. To change all this, you need to execute the following 30-day action plan. First, acknowledge the biological instinct. When you want to close a winning trade, say out loud to yourself, "This is my amygdala acting up." It is not the market giving a signal. Second, implement mandatory scaling. Set a mechanical rule, like must sell half at 1R. Do not let yourself make decisions during the session. Third, rely on trailing stops. Tell yourself, I am not responsible for how much profit I make. The market is responsible for the profit. I am only responsible for controlling risk. Fourth, data feedback. Review your shadow portfolio every week and let the data prove that patience has monetary value. The highest state of trading is not predicting the future. It is being at peace within uncertainty. When you can watch paper profits retrace 30% without your heart racing, because you know this is the admission fee you must pay to capture a bigger trend. That is when you have truly graduated. Finally, we have compiled a comparison of trading behaviors corresponding to prospect theory for you to understand and apply. In a gain state, the brain's value function is concave, meaning marginal utility decreases. Your psychology is risk-averse, fearing profit loss. Typical behavior is closing too early. The corrective strategy is scaling out plus trailing stops. In a losses state, The brain's value function is convex, meaning marginal pain decreases. Your psychology is risk-seeking, the gambler's mindset. Typical behavior is death-gripping losses. The corrective strategy is hard stops. Additionally, we compared 3 trailing stop strategies. ATR Chandelier Exit, suitable for trend following and volatile markets. Pros: automatically adapts to market noise, scientific and objective. Recommended indicator 3 times ATR, 14 periods. Market structure stop, suitable for swing trading. Pros: most rigorous logic, aligns with Dow theory. Recommended indicator, previous swing low. Moving average stop, suitable for strong momentum markets. Pros: visually intuitive, simple to execute. Recommended indicator, 8 EMA or 20 SMA. Today's episode referenced academic research from Odean, Barbaras, Kahneman, as well as strategy literature from practical institutions like Warrior Trading and TrendSpider. We hope to provide serious traders with dual armor, psychological and technical. Thank you for listening. We will see you in the next episode.